Joining us right now is Michelle Girard. She is the head of U.S. at NatWest Markets. And covering the equity angle is Joanne Feeney. She's a partner and portfolio manager at Advisors Capital Management. Michelle, what gives? This is pretty shocking to think that, okay, maybe rate hikes are back on the table. This is just based on what the market activity has been recently.
Well, there has been an easing in financial conditions, particularly as you move through year end, and the market got very euphoric about the possibility that the peak in rates was in and started to anticipate rate cuts. I think probably the market's a little ahead of itself. The Fed may be trying to, pump the brakes a bit in terms of market exuberance. But some of the data that we've seen of late may be doing that. The data isn't as weak as maybe the market had thought. The bottom line, though, is we do think that the Fed is done raising interest rates. And it really gets back to the fact that not only is the economy slowing, but more importantly, inflation is moving lower. And we'll get this week's number we can talk about. But I think the bigger story is how dramatically those year over year figures are going to start to decline as we get into the spring, given comparisons to very high readings in early 2023.
So you think rate cuts are coming when?
We think they start in May. So right now the market is betting mostly on a March start. The market is looking for a series as many as 6 25 basis point cuts. We don't think the Fed starts till May, but when they do start, we think they go more aggressively with 50 basis point rate cuts at a pop. And we think the Fed will end up cutting rates by over 200 basis points in 2024. Again, we have inflation year over year down under 2%. By middle of the year.
Michelle, we spoke with Roger Ferguson, the former vice chair at the Federal Reserve on Friday. And yes, I would call him Roger. We spoke with him on Friday after the jobs report that came out. And he said that if the Fed were to start cutting rates, let's say in the first half of the year, it would require that the economy took a significant leg down, that it was under some serious pressure. Is that what you think happens in order to get the rate cuts in May?
Yeah, I guess I should have said, not only do we see this dramatic decline in inflation, we do also, we're forecasting a recession. We think that by the middle of the year, we'll be seeing negative GDP. We're already seeing weakening. We think the consumer in particular is going to continue to come under pressure. And so it's that combination of inflation being back at or below target and the economy in a mild recession that we think leads to these aggressive rate cuts.
Joanne, we have seen the markets trade up pretty significantly on the idea that the Fed will start cutting rates sooner. If they do it because there's a recession that's taking place, does that still make sense from the market's reaction?
Our view is a little bit different. Yeah, our view is a little different. We don't think it's likely, at least in the data currently and projected, for the Fed to cut rates anytime soon. In fact, we think the market is far too optimistic about that. And moreover, the economy remains very strong. The consumer real incomes are rising. Real spending has been going up. The labor market remains very tight. So there's a lot of wage pressure, which is why we think inflation is probably a little bit slower to come down than some others think. Nor do we see a recession on the horizon, given the strength of the underlying manufacturing and services sectors in the U.S. So we think it's a little bit early to call a rate cut. And we do think, as you point out, Becky, that potentially could pressure equities. Valuations are taking into account those rate cuts, but we think that earnings, and more importantly, guidance, can be sufficiently strong to offset any reversal in those interest rate expectations.
So you think the market is maybe misjudging things from what's going to happen with the economy and with rates, but you think it's okay to stay long at these levels because you think companies will just perform pretty well anyway?
Well, the reason why we think the market is a little bit ahead of itself with those rate cuts is because the economy is so strong, is because the labor market remains tight. What does that tell us? It tells us that firms are still out there trying to hire, and they're doing it because they continue to see strong demand. And so in that environment, that sets up public companies pretty well to continue to grow sales and profits. We do think it's going to be something on the risk side to keep an eye on, which are a lot of those tail risks, whether they're geopolitical, China, Taiwan, China, the U.S. We heard over the weekend some more concerns about China restricting trade. So not that there aren't risks out there, but fundamentally the U.S. economy is still pretty strong in such a way that's keeping pressure on wages and potentially on inflation. So rate cuts are a little farther out.
Yeah, there are some people who are still looking at the markets right now and say that this is the year for all of the non-growth stocks to kind of catch up with the growth stocks. You think growth stocks are still actually a pretty good place to be?
Yeah, we have, depending on the strategy, we think there are roles for both in portfolios. Last year, a lot of the value and dividend-paying stocks really got hurt because money markets drew away so much out of the equity markets, particularly in those modest dividend payers. So we think there's a chance now that rates are going to at least flatten for some of that money to come back, especially with the anticipation that eventually rates will fall. Similarly, as you point out, value stocks really did not do well as growth stocks surged last year, but that was really AI-driven, AI-focused, very narrow market. This year, we do see lots of attractive opportunities in value and a broader recovery in areas of the market that suffered declines because of some weakness in spending associated with those higher interest rates we saw last year.
Joanne, you got any thoughts on Boeing? I don't know if it's stock you own or just watching the huge declines this morning.
Yeah, we have actually avoided Boeing. We've been concerned about their problems with the MAX and how long it would take for them to iron those out. We were a little bit enthusiastic about the recovery they were seeing in shipments to China. Obviously, now we're much less enthusiastic about taking another look at Boeing. Quality problems, I think, are going to make investors really concerned for quite some time about that particular name. We prefer, Raytheon, which also had an issue with the powdered metal contamination, but it's one that they really got ahead of. They revealed the big hit they were going to take to free cash flow. So we like Raytheon as a play in that market, also for its defensive role in a portfolio against things like geopolitical risks.
Michelle, very quickly, CPI this week, what are you looking for?
Like consensus, 0.2 overall, 0.2 on the core. The core will tick down to 3.9 from 4, so that'll be a good improvement from where we ended last year at 5.7. As I said, those declines are going to get even more dramatic, and that's where I think the Fed will find themselves questioning the need to have rates at 5.5% when inflation is so close to target. As Jay Powell has said himself, they're not going to wait until inflation is at target. It takes too long for monetary policy to act. To be having the foot this strongly on the brake when inflation, as I said, in coming months is going to make a lot of progress toward target. I think that's going to get that'll be the main impetus driving the Fed's decisions here.